Welcome to the Westside Investors Network. WIN, your community of investing knowledge for growth. This is the Real Estate Professionals Investing Podcast for real estate professionals by real estate professionals. This show is focused on the next step in your career, investing. Thank you for listening. And please, if you like our content, rate us on your podcast provider. Just a quick disclaimer, the views and opinions expressed in this podcast are for educational purposes only and should not be construed as an offer to buy or sell any shares or securities, make or consider any investments, or take any other action.
Welcome back to another episode of the Deal Deep Dive segment on the Westside Investors Network podcast. I'm your host, Trent Werner. In this segment, our featured guests will share their unique stories on a specific deal they've invested in. We will dive deep into finding the deal, financing the deal, writing an offer, and the due diligence. Do us a solid and smash that subscribe button, leave us a rating, and share this episode. And now, let's dive deep. Welcome back to the Westside Investors Network podcast. I'm your host, Trent Werner. On today's episode, we are joined by Michael Voulgarakis with Southgate Ventures. Michael and his partner have been investing in Seattle, Washington MSA for over 10 years now. And today, Michael and I are going to talk about how you can still be successful in these markets that may be considered high priced, may be considered more difficult to operate in. But Michael's going to debunk those myths today and share in detail how he and his partner have been successful investing in Seattle, Washington MSA. Now let's welcome Michael Voulgarakis. All right, we have Michael Voulgarakis joining the Westside Investors Network podcast today. Michael, thanks for taking the time to chat with us.
Absolutely. I'm really glad to be here.
So, Michael, I don't know if you've listened to any of our episodes or our conversations before, but typically what I like to do is learn more about you, Michael. I don't think everyone just was born and started in real estate. And we talked a little bit offline prior to starting this today. And I'm curious how your previous career has correlated with your current real estate career. So what did you do prior to Southgate Ventures?
Well, I started my career in IT client services. However, my father used to build homes, when I was younger, and I ended up, while I was working for these companies, buying some condos and renovating them, flipping them, living in some of them as well. And I realized that I was having a lot of fun. Number one, it was because it was profitable. I enjoyed the work. And I said to myself, I really want to understand the income producing real estate side of things. I had some education in it, but not nearly enough. So I decided to go back to graduate school. I went back and got a master's degree in commercial real estate finance in New York City, took a job in New York City, and I've had appraisal, asset management, and underwriting jobs before starting Southgate Asset Management with my partner.
Very nice. And were there any, skills or traits that you learned doing IT that have correlated or transferred to all of your, vast real estate experience at this point?
I would really say the big thing is the communication with customers, right? That was the side of the business I was on, to make sure that IT implementations were going smoothly, vet problems as quickly as possible, solve them. And in general, it's just a great skill to have. And it also helps with investor communication as well. Communicate frequently, tell people what's going on, and your investors, when they're well informed, it really creates a very happy investor overall.
Yeah, you mentioned two things there that I think anyone can learn from. One, being able to solve problems and communicate those problems and the solutions. And two, being able to think creatively to get to a solution from a problem that arises. So that would make perfect sense in my opinion. And I think those are skills, like you said, anyone can use in their entire life. So Michael, what is Southgate Ventures and what do you guys focus on?
So Southgate Ventures purchases value add multifamily and core multifamily assets in the Puget Sound region, so Seattle, Washington, the Seattle MSA. And we've been buying properties there for close to 10 years now. And we continue to grow, and it's a market that we're very focused on. It's the only market we're buying properties in at present, because we believe that it has tremendous economic growth drivers and a pretty large pool of assets that are prime for value add strategies. So that's why we're sticking with that original thesis, because there's plenty more runway to go in that market.
I don't know if you guys thought about this prior to investing in Seattle area, but have you ever considered any, I guess, natural disaster regions or anything like that? And when you were thinking about that, or if you thought about those, is that why you chose to stay in the Pacific Northwest, or is that not a factor?
It wasn't a factor. However, we're cognizant of certain markets that my partner and I had been exposed to when we were colleagues at a company. And for example, Florida or areas in California, flooding slash fires. And we recognize that, for many reasons, we didn't have any connections in those markets. And then we also said, well, let's cross those off. We're not really, I'd love to buy something in Miami on the beach. However, maintenance costs, capital expenditure costs for those types of buildings with all the salt in the air is incredibly high. Insurance is incredibly high, and it's only gotten worse over the years. That doesn't mean that, investors can't make it work in those markets. It just wasn't something that was in our wheelhouse. And we decided, let's go with something where we feel a little bit more comfortable without taking on that, what I would call environmental risk.
So you guys chose the rain.
I'd rather have the rain than the hail or snow or salt water or fire. Yes, absolutely.
I think that's the safest out of all of them, if I had to guess. So, Michael, you mentioned something about Florida, for example. Very different, I guess, market on the spectrum of real estate markets. What are some of the things? Because people talk, headlines are headlines. One person would say Florida's great, it's very business friendly, yada yada yada. But then the flip side of that is insurance costs have gone through the roof, taxes can go, all these things. What would you tell someone on the other side of the spectrum that would say, I'm in Portland, Oregon, for anyone that doesn't know, so I'm very familiar with what Seattle, how Seattle operates, because Portland's Seattle's little brother. So, what would you tell someone that says, well, you can't invest in Seattle, the deals don't make sense, there's rent control, yada yada, all the political things going on? I guess, what would you tell someone that would say you can't do any of the things that you're doing in this market?
I would say that you cannot make an overarching assumption like that about any market. You can't say some blanket statement that says, Texas and Florida good, West Coast bad, right? What I mean by that is you have to dig a little deeper. And the question really should be, how are people making money in various markets? Because, for example, I know someone very well who is making really good money in San Diego. And people say, well, how is that possible? How can you possibly buy real estate and make money in San Diego? Well, they passed accessory dwelling unit laws. So he's able to take a 1 or 2 family home, add a 3rd or 4th unit on there, and make money that way. I know other people who are making money buying apartment buildings in Los Angeles. And I would really caution people again from not just placing a blanket statement over something and totally writing it off, because I think what they're missing is opportunities to invest where other people are not. So if everyone's flocking to the Sun Belt to buy apartment buildings, and less people are flocking to some of these other markets that, the national headlines would have you believe no one can make money in, I would say, again, go talk to operators in that market and figure out what niche do they have that they're making money in. Because as you alluded to before, some people will say the prices in Seattle are too high. It's not possible to make money. Well, we've been buying properties there for 10 years. and we are making money. So how is that possible? I would encourage people to talk to sponsors in those markets and figure out what their niche is, and get themselves better educated before they make a blanket statement like that.
Yeah, that's really good. I mean, there's going to be good deals in markets, and there's going to be bad deals in markets. It doesn't necessarily what market or mean what market you're in, but rather can you find a good deal in said market?
Absolutely.
One question I have for you, because like I said, Portland and Seattle area are similar in terms of the rules and regulations and laws that are up there. I've had a lot of people that I've known that have left Portland because of some of these laws, saying, they're too strict. We can't, our hands are tied. We can't do anything with evictions and moratoriums and all that stuff. What have you guys done, especially in the last 4.5, 5 years? And how have you been able to handle some of these new laws that have passed when it comes to evictions and that sort of thing?
Well, the tenant landlord laws in Seattle are not nearly as onerous as many people believe. I think there's some huge misconceptions out there. Number one, Washington State does not have rent control. It was banned by the state legislature in 1981. Does the legislature continue to, or do people continue to bring that up as a possible law in Washington State? Yes, they do. But to me, it's consistently shot down. Over the past 10 years, it's been brought up maybe 2 or 3 times, and every single time it dies before that gets passed. The other thing is the other rules are really quite, I would think, equitable. Number one, we have to provide tenants with a notification if we're raising rents above a 5% level. And that notification is 180 days. Well, we satisfy that requirement by putting a rent notification into a tenant's original lease. So instead, we give them 365 days, and we say, hey, your rent can go up to this amount. Now, we're not going to charge someone an above market rent, right? The market will dictate, tenants will dictate, that is, what they're willing to pay. So we'll put a relatively decent increase in there based on what we're seeing forecasted increases are going to be in that market per CoStar or Green Street or any of these other systems that provide forecasting data. And that's how we satisfy that requirement. We've never had any complaints from tenants. At the end of the day, it's a conversation about how much we can raise rent with a tenant, what they're willing to accept, what we're willing to accept. And like any other interaction, we treat people with respect, and we can either agree on a rent increase or we cannot agree on a rent increase. So that's fairly simple. The only other thing is the potential to pay out relocation assistance money to tenants that make below a certain percentage of area median income. And it varies between, how many people are in the household, 1, 2, 3, et cetera. And that is really not that onerous as well, because a couple reasons. One, we're buying in B plus areas. So we're buying Class C, B buildings in B or B plus areas. And our average tenant is making $95,000 a year. So well-educated, high-earning tenants, they don't meet any of that, those area median income thresholds. And so we've never had to pay out any of those payments. And it's also not that onerous of a payment if we had to pay it out, because there's a state fund that will pay for half of it, and the landlord has to pay for the other half. And I think it's 2 months that the landlord would have to pay. So it's not that big of an expense, and we just haven't experienced it given the tenant profile of who we're renting to.
And now here's a word from our sponsor.
Get things done while you're on the move. Learn more about working with a virtual assistant through Offsite Professionals. It's a great way to get all the things done that you need to get done. Have freedom in your time and streamline your life by automating your business. Stop spending time on the tasks that you can delegate and start spending more time on your superpower. Call us today. at 503-446-3177 or visit our website at offsiteprofessionals.com.
Uptown Syndication is now offering a syndication coaching program for you to take your real estate portfolio to the next level. This is your opportunity to have experienced syndicators, AJ and Chris Shepard, coach you on your way to controlling your real estate investing future. Our coaching program will provide you with the tools and framework needed to begin syndicating real estate in your target market. Go to uptownsyndication.com today to learn more. I mean, I gotta be honest, after hearing how loose the requirements are up in Washington, you guys are living in the wild, wild west compared to Oregon and California. Jeez.
Yeah, it's Seattle gets lumped in with LA, with Portland, and I continually have to say politely, no, actually that is not the case, and explain the same thing that I just mentioned to you. A lot of people are shocked by it, but it's you couple that with the growth market that Seattle is, and it helps with the business plan, certainly.
So I know Seattle's got plenty of growth. I mean, apparently they got way better landlord tenant laws than we have down here. What's your thought on the cost of the Seattle MSA? Because that's a big one that people talk about. I have a cousin or second aunt or something like that that is actually in real estate up there. She's a broker, and she sent me some of her listings. Then it's crazy how expensive they can get. So where does that play into your guys' underwriting and assets and portfolio?
Well, it's a great question. It really goes back to the underlying economic fundamentals in that market. So Seattle is a market where, and you know this well, it is driven by tech, AI, aerospace, biotech, and medical job growth. And the amount of jobs that are there is prompting massive population growth as well. Then if you layer on the supply deficit, you have a supply and demand problem where more people want units than are available. That helps drive up prices. It's appreciation, essentially. And as far as doing the math on a building, it really comes down to, can these tenants afford the rents that we are projecting? And in our experience in 10 years, having owned 27 assets in that market, yes, they can afford the rents. Now, obviously, there is a level at which they cannot, right? And we have to be competitive with every other building in the market too. But when you look at Seattle on a price per door basis for apartment buildings, for example, and you compare that to Silicon Valley or Los Angeles or San Diego, and this was part of our original thesis, we said, this is very inexpensive compared to these other markets. I'm not saying that Seattle will ever be Silicon Valley or LA or San Diego, purely, I say this in jest, like because of the weather, right? But the price per pound is very reasonable compared to other West Coast markets. And if you're someone who's working in tech, AI, aerospace, etc., and you're living in California, and you have an opportunity to take a job in Seattle, and you recognize that, wait a minute, Washington State does not have state income tax, so I'm saving a ton of money there. And then you couple that with the fact that the rents are more affordable than where you are living now. It's sort of a double benefit to an individual's bottom line. So that is in part why a lot of people are moving there. They say, especially young people, they say, I finished school. Why wouldn't I go to Seattle for a few years? I'm going to get to bank a lot of money, keep a lot of my own money that I've made, get incredible experience. Maybe I stay, maybe I don't. But that's our typical renter profile. But it really comes down to, can the tenants afford to pay those rents, and the math of doing a pro forma in order to arrive at the purchase price for your building. And there's no shortage of properties out there that we can buy and run profitably because of that.
And again, this might be getting too into the nitty gritty. I'm not expecting you to know the answers off the top of your head for all of these questions, but when it comes to taxes and insurance and some of the other expenses that have just ballooned across the country over the last 12 to 18 months, does Washington have anything in place that caps those, or is there no caps on property taxes and insurance and that sort of thing?
I don't know of any caps on either of those expense items. However, the taxable rate, your assessed value on properties for us has not been going up as fast as I've heard about in other markets. Insurance is a different story, though, right? Although it's not in a flood zone, although it's not in an area that's prone to wildfires, Seattle, like every other market in the country, has sort of been thrown in the pool with all those other markets, and we're experiencing rate increases, premium increases. It depends on the asset you're buying, though, right? If you're buying an asset that is older, that's unsprinklered, so an apartment building from the 1970s, no sprinkler systems, you're going to get dinged for that. If you're buying an apartment building in the 80s with a sprinkler system with no losses on it, either during our ownership period or the prior owner's ownership period, the increases are much less severe. But I was just speaking to someone who's a former colleague of mine in New York today, and we were talking about insurance in general. They're a commercial real estate lender, and nobody knows where insurance costs are going to end up. So when they're underwriting loans, they're adding really, really heavy premium increases across all markets, even more so in those markets that are subject to flooding, fire, etc.
Yeah. And the reason I asked is because obviously I think everyone can attest to the fact that insurance is going up. But in, Portland Metro, our property tax rates, like you said, are pretty consistent. They're not gonna jump on you. And we looked at a deal in Texas that I think it was Texas, either Texas or Florida or one of the Sun Belt, down south somewhere, where the deal they take the property tax rate based on the new purchase price, and it quadrupled the property taxes in 1 year. And so I was curious if Washington had anything similar to that.
Yeah, they do. I mean, most markets do, based on my experience. Any deal that we are underwriting, we are going to whether it's a value add deal or a core, a stabilized deal. In our underwriting model, we're going to look at the existing assessed value and the mill rate, and then we're going to look at the purchase price, right? If there's a huge gap between assessed value and what we're paying for the property, your property taxes are going to go up. And they're going to go up to about 95% of the purchase price. So we underwrite that in there as a safety measure, right? Because once that property sale hits the tax rolls, they flag it. They say, well, if you were willing to pay $8 million for a building, that is the value of the property. So we're going to mark our assessed value to that. So we do take that into account, and it's not an uncommon thing across the markets that I've been exposed to.
And last question about the Seattle market in particular, in terms of just data. What would you guess, or if the, I guess, average rent increase on an annual basis across your portfolio or the market?
This is a great question. We have seen 5, 6, 7% rent increases for the most part over the past few years. During the pandemic, our rents dropped by very low single digits because there was a softening in the market, but there was no major fallout. Most people, especially if they're working in tech, they were just working from home, right? And there was a little bit of softening in demand, but we've seen consistent rent increases pre-pandemic and post-pandemic as well. And depending on the market, sub-market rather, in Seattle, there are some instances where CoStar, Green Street, et cetera, are forecasting 5, 6% growth. Many of them are 4% growth. But very strong rent growth, given that construction starts have fallen tremendously since the Fed started raising rates, and you still have this influx of people for very high paying jobs. That's why they're forecasting those rent growth as well.
Sounds like a great result for your guys' business and portfolio then.
Yeah, it continues to be a true growth market, right? It's a market that you're getting a significant amount of your return from appreciation. The buildings do cash flow as well, for sure. But if anyone is out there and they're interested in getting exposure to, I like to call it the talent magnet that Seattle is, and these incredibly high-paying jobs of the future. And I think a growth market should be part of everyone's portfolio, especially for diversification, right? If you're all in, let's say, the majority of an investor's money is in multifamily or mobile home parks, let's say, throughout the Midwest or the Sun Belt. Well, you're kind of overexposed at that point, right? You should probably start thinking about taking some portion of your portfolio and putting it into a market that has no correlation to your existing investments, right? Seattle, it would be one of those. There's many other markets too, but that's sort of where we fit in with investors, and if they're looking for a growth market.
Awesome. Yeah, and Michael, you said that right now you guys are focused on operating your current portfolio, obviously still underwriting deals. What kind of deals are you looking for currently, in case anyone listening might have a deal that would meet your criteria?
Well, we're looking for either multifamily or mixed use, value add, or core deals anywhere in the Seattle area. So we'd like to buy stuff ideally that is commuting distance to either Redmond, Washington, which is where Microsoft is headquartered and many other businesses, or downtown Seattle itself. Our deal size ranges from about 3 million up to 10 million. So that's the sweet spot we're playing in right now. And if anyone has any properties that they're looking to sell on market or off market, we've certainly purchased plenty of both. We'd love to talk to them.
Very nice. And Michael, how can people connect with you? Website, social media?
The best place is to go to our website. And the company, again, is Southgate Real Estate Ventures. So our website is sreventures.com.
Very nice. Well, Michael, did I miss asking you questions, or did you have anything else you wanted to share today?
No, I think that was it. I appreciated getting an opportunity to talk shop with you, to talk about West Coast markets versus other markets as well, and hopefully we've debunked some myths that some people might not realize were simply untrue.
I would say that you did. You debunked myths that I guess I had in my own head that I hadn't done any research on, but you definitely taught me something today, and I know our listeners will get the same experience.
Fantastic. Again, it was a pleasure being on the show. Thank you very much, Trent.
Thanks, Michael.
Thank you for listening to this episode of the Real Estate Professionals Investing Podcast on WIN, your community of investing knowledge for growth. We hope that this episode has increased your knowledge and added value to your path to freedom. If you would, please take a second to rate us so that we can get more great investors to interview. If you or someone that you know wants to be on, please visit westsideinvestors.com and fill out our form to be on the show. Thank you again and enjoy your day.